Welcome to the Deep Dive, where we extract the essential knowledge you need to cut through the noise and be truly well-informed. Today, our mission is pretty fundamental. We are diving deep into the core economic forces that don't just, affect the market. They actively shape your portfolio and dictate investment behavior. We aren't here to predict the future or anything like that. We're here to give you the framework to understand the inevitable movements of capital.
And that framework is so crucial. I mean, if you follow the financial news, you see these constant headlines about rates, inflation, recessions. Our goal today is to go past those headlines and give you a solid understanding of the mechanisms, the why behind how these major economic factors interact and ultimately affect your outcomes as an investor. This knowledge really is the key to managing expectations and building that confidence you need for long-term resilience.
So we're exploring a set of powerful interacting variables: interest rates, inflation, economic growth, employment, and then you've got these layers of global policy and currency influence on top. Think of it as peeling back the layers of the global economy. Okay, so let's unpack this, starting with probably the most powerful and often misunderstood lever of all, monetary policy, specifically interest rates and inflation. So let's start with interest rate dynamics. The central bank uses this not just as a temperature gauge, but it's like an actual brake on the economic machine. When they signal higher rates, they're basically making the cost of capital more expensive across the whole system.
Exactly. We know the immediate effect is to slow down spending, but for your portfolio, the devil is really in the details. So new bonds become inherently more attractive because, well, they offer higher yields. But the real nuance is in the existing bond market. That's where prices fall, sometimes dramatically, especially for those long-duration bonds. And that volatility often catches investors completely off guard.
And on the equity side, it's a double whammy, isn't it?
It really is.
Companies face higher borrowing costs, which squeezes their margins, and at the same time, the present value of all their future earnings, it just falls. And that just hammers those high-growth tech stocks that are relying on earnings projected way out into the future.
Precisely. We often see a market rotation. Growth stocks, which are really sensitive to that future discounting, they tend to suffer. Meanwhile, value stocks, which, tend to have more immediate cash flow and better pricing power, they might hold up a bit better. And like you said, property markets cool almost immediately. Higher mortgage rates just eliminate buyer affordability. It's a very direct transmission of that policy.
Okay, then we shift gears to inflation, the silent killer of capital. Rising prices mean the real value of your money is falling. It's a guaranteed loss of purchasing power, and that's a very real concern for people.
And this is where we need to introduce maybe a deeper concept. The inflation factor is why holding huge amounts of cash is a problem. Its value just erodes, predictably. Bonds, though, they struggle even more profoundly than in just a rate hike environment. We look at something called the break-even inflation rate. That's the point where your fixed income returns just can't keep up with rising costs. And that forces investors to start looking for alternatives.
But certain assets do offer some structural protection. Equities can hold up if the companies have the pricing power to pass rising costs onto the consumer, right?
They can, yes.
But tell us why real assets, things like commodities, infrastructure, or property, are always touted as the real hedge.
The reason is actually pretty simple. It's inelastic supply and replacement cost. So if inflation is caused by rising input costs, what we call cost push inflation, well, commodities are the inputs themselves. Their price goes up before the final product does. And property values, they often track the rising cost of construction and land replacement, so they act as this tangible store of value that mirrors the inflation happening around them. So to connect this back to strategy, long-term investing, especially in well-chosen growth assets like equities, it isn't just about trying to get rich. It's fundamentally about securing your wealth so it grows above the rate of inflation. It's really a defensive strategy against the erosion of money's value.
Right. Moving from those policy controls to the performance of the economy itself, let's talk about the engine room, economic growth. When the economy is growing robustly, we see earnings per share expanding, consumer spending gets stronger, and, market confidence builds. That's the high point where we see PE multiples expand.
And here's where it gets really interesting, because the market cycle is probably the most powerful natural force we track. These growth cycles, driven by excess liquidity and high confidence, they just can't last forever. They inevitably sow the seeds of their own destruction through things like overinvestment, excessive risk-taking, and then policy tightening.
And this leads to the inevitable downturn. We use terms like slowdown or recession, and during these times, companies struggle, sentiment plunges, and investors are so tempted to panic sell. But you have to remember the context. A downturn can be a necessary cleansing mechanism.
Absolutely. Downturns do not mean your long-term plan is failing. They are natural. They're healthy parts of capitalism. For disciplined investors, they actually create opportunities, the chance to buy high-quality assets at a discount just because short-term fear is overriding long-term fundamentals.
But how do we distinguish between, say, a healthy cyclical slowdown and something that signals a deeper, more structural failure?
We rely heavily on leading indicators, and one of the most visible is the employment index. High employment seems unambiguously good, right? It supports spending and corporate performance, but if employment gets too tight, we start to worry about wage inflation, and that then puts pressure on margins and pushes the central bank to tighten policy even further, which just accelerates the cycle toward its peak.
So paradoxically, excellent employment numbers can sometimes signal an overheating economy that's getting close to a policy break.
That's the complexity we deal with. And conversely, rising unemployment signals weakness, it reduces future spending projections, and it increases caution. When clients see job loss headlines, the behavioral response is immediate and it's emotional. Our job is to remind them that this news often reflects the tail end of the cycle, not the long-term potential of their diversified assets.
Okay, now let's layer on the global elements, starting with the influence of global currency and exchange rates. For, a domestic-only business, this might seem irrelevant. But in a globally diversified portfolio, currency adds a really profound layer of complexity and volatility.
It does. Let's take a company that sells goods mostly overseas but reports its earnings in its home currency. If the local currency strengthens those overseas sales, when you convert them back, they yield fewer domestic dollars or pounds. It directly impacts the reported profits of multinational companies, even if their actual sales volume hasn't changed at all.
So a strengthening local currency makes imports cheaper, which should help fight inflation, but it hurts your exporters and the returns you see in your foreign stock holdings.
It's the perfect mirror image. A weakening currency helps exporters and can boost the local currency value of your foreign investments. For investors, this is why strategic diversification across geographies is so essential, because currency movements tend to flatten out relative returns over longer time horizons. Trying to time currency shifts or hedge them completely is a really complex game best left to professional managers.
That makes a lot of sense, especially for long-term capital allocation. Okay, let's move to government policy and fiscal decisions. These are often sudden and very powerful shapers of market sectors.
Oh, absolutely. Changes in taxation, public spending, regulation. These are the kinds of external shocks that can instantly shift the competitive landscape. Imagine a major infrastructure bill passes. That immediately boosts construction, materials, and engineering sectors.
While on the other hand, a sudden tightening of, say, data privacy regulations could instantly pressure the big tech platforms, regardless of how profitable they are at the moment. You can't predict the next administration's regulatory agenda, so how does that translate into building a portfolio?
It just highlights the necessity of sector diversification. Instead of trying to guess which tax code or regulation is going to win out, the goal is to make sure your portfolio isn't overly concentrated in a sector that's facing immediate political headwinds. Strategic resilience really means building a plan that's tough enough to handle these inevitable fiscal policy shifts, which, by the way, often override short-term economic fundamentals.
We've talked mechanics and policy, but now we have to address the human element, the fear and greed that really fuel volatility. Let's look at consumer confidence versus core fundamentals.
Confidence is just the willingness to act. When people feel optimistic, they spend, they borrow, they invest based on their future expectations. When they're uncertain, they pull back. They hoard cash and delay big purchases. And that shift in spending directly feeds into corporate sales forecasts.
But this is where that short-term sentiment gets disconnected from long-term value. Confidence surveys are just snapshots of a momentary gut feeling. How often do we see market sentiment completely detached from reported earnings or even robust economic data?
Constantly. Markets move on emotional cycles. Fear, greed, optimism, pessimism, as much as or even more than they move on hard data in the short run. I mean, think about the flash crashes or panic sell-offs we've seen, often triggered by a geopolitical event or some unexpected news item. These emotions are what create that volatility.
Okay, so here's my challenge. If markets are so emotional, how can we realistically tell people to simply ignore that emotion? Isn't that ignoring a fundamental driver of the market?
That's the critical distinction. We don't ignore sentiment, we guide against reacting to it. Legendary investors know that emotional reactions, selling out of fear at the bottom or chasing gains out of greed at the peak, are the primary destroyers of long-term wealth. Our job is to maintain that discipline and clarity, reminding investors that their strategy is actually designed to weather these short-term emotional swings.
So what's fascinating here is that we can't really study these factors in isolation, can we? They are constantly interacting. Interest rates affect inflation expectations, which shifts consumer confidence, which then impacts the economic growth cycle. It's an incredibly intertwined system.
And this is why market responses are so complex. It's not just the data, it's the interpretation of the data. Investors see a good jobs report. Is that a sign of lasting strength? Or is it a signal that the Fed has to raise rates even harder? Different interpretations lead to varied and sometimes contradictory market reactions, which just increases the short-term noise.
So what does this all mean for the strategic mandate? I mean, if we understand all this complexity, what is the core task? It's certainly not predicting the next move of the Fed or the next geopolitical flare-up.
No. The role is to contextualize these external forces, to translate their complexity into simple, actionable explanations, and ensure the client maintains their strategic conviction. Long-term success relies on patience, discipline, and a resilient, globally diversified strategy that accepts volatility as normal, necessary, and temporary. We manage the client's behavior, not the market's factors.
That is the essential message. Focusing on what you can actually control, which is the structure of your portfolio and your own behavioral response. So let's wrap up this deep dive. We've covered the powerful levers that shape the investment landscape: interest rates slowing growth, inflation eroding fixed value, market cycles demanding patience, currency adding global volatility, and policy shifting sector performance. These economic forces, they shape the market, but they don't define the long-term success of a carefully constructed plan. The consistent antidote to navigating all this complexity remains strategic resilience and behavioral conviction.
Absolutely. We spent a good amount of time talking about how much noise and complexity arises from the interaction of these forces and, the varied interpretations by investors. This raises an important question for you to consider. If market success relies on clear communication that translates all this complexity into simple explanations, what is the single most confusing or often misinterpreted economic indicator you encounter in the news? The one you see people consistently getting wrong. And how does that misunderstanding impact investor behavior?
Something to mull over as you consume the next round of headlines and try to determine whether the market is reacting to fundamentals or simply reacting to fear. Thank you for joining us for the deep dive. We'll talk to you next time.